Welcome to the deep dive. Looks like you guys have been sending in a ton of stuff about macroeconomics and investing, and it seems like you're all struggling with a really big question.
Hmm.
Does paying attention to the big economic trends actually help you make better investment decisions?
Yeah,
Or is it just noise?
right.
So your main source this time is the book Big Money Thinks Small. It's by Joel Tillinghast.
Okay.
But you've also included some pretty big names, like Warren Buffett,
Right.
John Maynard Keynes,
Yeah.
even George Soros.
Wow.
So what we're going to try to do today is figure out how macro trends and investing
Yeah.
actually connect or don't. And by the end, you should have some solid takeaways to apply to your own portfolio.
We'll try to make it clear,
Exactly.
regardless of your expertise.
So let's start with a question that might seem a little counterintuitive.
Okay.
If the economy, the overall economy affects things like stocks and bonds, and it obviously does,
Right.
why wouldn't every investor want to be a macro expert?
Well, even though it seems logical to follow the macroeconomy, some of the most successful investors, including Warren Buffett, actually say they don't focus on macro issues when making their investment decisions.
Now, that's interesting. How can that be? I mean, it seems like understanding the big picture
Hmm.
is crucial.
It's not that understanding the big picture isn't important.
Okay.
It's more about the sheer difficulty of accurately predicting macroeconomic trends. It's incredibly complex,
Yeah.
even for experts.
Right.
There are so many variables and interconnected factors
Right.
that it becomes exceedingly difficult to grasp the whole picture,
Yeah.
let alone predict how it will play out.
So it's less about being smart and more about the inherent complexity of the system itself.
Precisely. A great example is John Maynard Keynes, who literally wrote the book on macroeconomics.
Right.
You would think he'd be a master at using his own theories to make money in the market.
Yeah, you would assume so.
But early in his career, Keynes tried to do just that,
Okay.
focusing on foreign exchange and futures,
Hmm.
because they're so closely tied to macro trends.
Yeah.
Unfortunately, he lost a significant amount of money
Yeah.
because his predictions were consistently wrong.
Wow. So even Keynes couldn't crack the macro code.
Well, not at first.
Okay.
This experience led him to change his whole investment philosophy. He shifted away from trying to predict the macroeconomy and moved towards a value investing approach.
So instead of focusing on the big picture, he started looking for undervalued companies.
Yeah.
What exactly does that mean? What is value investing?
So it's a strategy where you look for companies that are trading at a price lower than their intrinsic value, meaning they're essentially on sale.
Yeah.
Keynes found that it was much easier to identify these undervalued companies
Okay.
and profit from their eventual price correction than to accurately predict the ups and downs of the entire economy.
Okay. That makes a lot of sense. It's about focusing on what you can reasonably analyze and understand.
Exactly. And it's not just Keynes. Robert Shiller, another Nobel Prize-winning economist,
Wow.
successfully predicted 2 market crashes. He emphasizes that relying solely on macro indicators is unreliable for making investment decisions.
So we have two brilliant minds in economics telling us that macro predictions are essentially a gamble.
Yeah.
It seems to contradict the idea that macroeconomy affects everything.
It does seem contradictory.
Yeah.
Truth is, for most of us, trying to play the macro game is likely to backfire. I mean, if economists with PhDs
Right.
who dedicate their lives to this field struggle to get it right,
Yeah.
what chance do the rest of us have?
Good point. I mean, it's easy to feel like you're missing out by not paying attention to the big economic trends. But maybe it's better to focus on something more manageable.
Absolutely. And that's where Joel Tillinghast's book, Big Money Thinks Small, comes in. Remember, he manages billions of dollars,
Right.
and his entire approach revolves around ignoring macro noise
Okay.
and focusing on specific, answerable questions about individual companies. He looks for what is knowable and actionable.
That title is really powerful. Big Money Thinks Small, it perfectly sums up our discussion.
Yeah.
So what kind of questions does he ask? I mean,
Instead of getting lost in complex economic forecasts,
right.
he asks practical questions like, why do consumers buy this company's product?
Okay.
What makes them different from their competitors? What could cause this company to fail?
Yeah.
He's digging into the core drivers of a business,
Right.
the things that truly determine its success.
So he's getting down to the nitty-gritty, understanding the business itself, rather than trying to predict where interest rates or inflation will be in 6 months.
Exactly. He's focusing on what Warren Buffett calls the important and knowable, the things that you can truly analyze and understand.
So if we're not supposed to obsess over macroeconomics, what should we be focusing on?
Well, there are several knowable and actionable factors
Yep.
that individual investors can focus on. Things like asset allocation, fees and costs, and managing cash.
Those all sound much more tangible than trying to guess where the S&P 500 is headed next week.
Yeah.
So let's unpack those a bit further. Let's start with asset allocation. What is that?
So asset allocation is all about deciding how to divide your investment money
Okay.
among different asset classes like stocks, bonds, and real estate. It's like building a diversified portfolio.
It's like creating a recipe for your investment strategy, choosing the right mix of ingredients.
Exactly. And the recipe will depend on your individual circumstances, your risk tolerance, time horizon, and financial goals will determine the right mix of assets for you.
So for instance, someone who's young and has more time to recover from market fluctuations might allocate a larger portion of their portfolio to stocks, which have the potential for higher returns, but also come with higher risk.
That's right. On the other hand, someone closer to retirement and focused on preserving capital might opt for a larger allocation to bonds, which are generally considered less risky.
So it's about finding the right balance for your specific situation.
Precisely. And the best part is that it's something you can control. You're not trying to predict the future. You're making informed choices about how your money is invested based on your own needs and goals.
Makes a lot of sense. So what about fees and costs? How can we make sure those aren't eating into our returns?
Well, this is an area where people often underestimate the impact. Every dollar you pay in fees is a dollar that's not working for you in the market. It's like a silent drain on your potential profits.
It sounds like something that can really add up over time. What's the best way to minimize those costs?
Well, one of the most effective ways is to stick with low-cost index funds. These funds track a specific market index, like the S&P 500, rather than trying to beat the market through active stock picking. They're passively managed, which keeps their fees much lower than actively managed funds.
So it's about keeping it simple and efficient.
Exactly. And another crucial point is to be mindful of trading commissions. Frequent buying and selling can rack up significant costs, especially if you're not careful.
So patience and a long-term perspective are key.
Absolutely. It's not about timing the market perfectly. It's about making sound, long-term investment decisions. And avoiding unnecessary costs along the way.
This all makes a lot of sense. So we've covered asset allocation, fees, and costs. What about managing cash? I mean, it doesn't sound as exciting as picking stocks, but I'm guessing it's pretty important.
Yeah, it's often overlooked, but managing cash effectively can be a game changer. It starts with figuring out how much cash you need on hand for emergencies. Short-term goals or unexpected expenses. This is your emergency fund, and it's crucial for peace of mind.
It's like having a safety net, which allows you to make more confident investment decisions.
Exactly. Once you have your emergency fund sorted, you can focus on making the rest of your cash work harder for you.
So instead of letting it sit idle in a low-interest checking account, we should be looking for ways to earn a decent return.
Exactly. There are plenty of options available, depending on your risk tolerance and time horizon. You could consider high-yield savings accounts, money market funds, or even short-term bond funds.
So it's about finding the right balance between liquidity or being able to access your money quickly and return, or making sure it's growing at a decent rate.
You got it. And just like the other factors we've discussed, it's within your control. You don't need a PhD in economics to manage your cash effectively. Just a little research and some sound decision-making.
This has been incredibly insightful. We've covered a lot of ground here. But we need to take a quick pause. When we come back, we'll explore some more specific examples of investors who have found success by ignoring the macro noise and focusing on what they can control.
Sounds good. As we've been discussing these knowable, actionable elements of investing,
Yeah.
it strikes me that maybe we often approach investing with the wrong mindset.
Hmm.
We tend to think of it as a high-stakes game of chess,
Right.
constantly trying to outsmart the market.
Yeah, it's true. We feel like we need to be these financial masterminds, always 5 steps ahead.
Exactly. But what if we're looking at it all wrong?
Okay.
Maybe investing is more like gardening than chess.
Okay. I like that analogy. Tell me more.
Well, think about it.
Okay.
In gardening, you're not trying to control every single variable.
Right.
You can't control the weather.
Yeah.
You can't perfectly predict the soil composition.
Right.
And you certainly can't control every pest that might come along.
That's true. But you can choose the right plants for your climate.
Yeah.
You can amend the soil to make it more fertile. And you can take steps to protect your plants from those pests.
Precisely. Investing is similar.
Okay.
We can't control the macroeconomy.
Right.
We can't predict every market fluctuation.
Yeah.
But we can choose investments that align with our goals, manage our risks carefully, and nurture our portfolios over time.
So instead of trying to be these all-knowing market wizards, we should be thinking more like patient gardeners, tending to our investments and allowing them to grow organically.
I love that. And just as a gardener needs to understand the basic principles of plant care,
Right.
we need to understand the core principles of sound investing.
Things like diversification, value investing, dollar cost averaging, those timeless concepts that have proven themselves over decades.
You got it. This brings us back to that idea of focusing on what's knowable. Those fundamental principles are knowable.
Yeah.
They're not based on some mystical ability to predict the future,
Right.
but on a solid understanding of how markets work and how to position ourselves for long-term success.
It's an empowering message.
Yeah.
Especially for those who might feel intimidated by the complexities of finance. You don't need to be an economics whiz to be a successful investor.
Absolutely. You just need a willingness to learn the basics, the discipline to stick to your plan,
Yeah.
and the patience to let your investments grow over time.
And maybe spend a little time in the garden, getting your hands dirty and watching things grow.
Now you're talking. You know what I love about gardening?
What?
It's a constant learning process.
Yeah. You're always discovering something new, trying new techniques, finding ways to improve.
Exactly. It's the same with investing.
Yeah.
Markets are constantly evolving.
Right.
New industries emerge.
Right.
Technologies disrupt old ones. And we need to be lifelong learners.
Right.
Staying curious and seeking out new information and perspectives.
It's the journey of continuous learning and discovery that makes investing so fascinating.
Yeah.
Okay, so we've agreed we shouldn't strive to be macro experts.
Right.
We should focus on the knowable aspects of investing. But even when we zoom in on individual companies, there's still an overwhelming amount of information. How do we avoid getting stuck in analysis paralysis?
It's a varied concern.
Yeah.
Having a framework, a set of guiding principles can be immensely helpful.
Can you give us an example? I mean, what kind of framework do you use when you're evaluating a potential investment?
Of course.
Yeah.
I always begin by trying to understand the big picture.
Okay.
What's the company's story? What problem are they solving? What is their unique competitive advantage?
Right.
I want to grasp their core business model
Yeah.
before I even look at the numbers.
It's like getting to know a person before you judge them solely on their resume.
Exactly.
Yeah.
Then I delve into the financials,
Okay.
revenue growth, profitability,
Yeah.
debt levels, and so on. But I always connect those numbers back to the story.
Right.
Are the financials a reflection of what I'm seeing in the business itself?
So it's not just about crunching numbers in a vacuum. It's about understanding what those numbers actually represent about the company's operations.
Precisely. Next, I take a close look at the management team.
Okay.
What's their track record?
Right.
Do they have integrity? What is their vision for the future?
Yeah.
Because ultimately, when you invest in a company,
Right.
you're investing in the people running it.
It's like choosing the captain for your ship. Experience, trustworthiness, and a clear sense of direction are crucial.
Perfectly said.
Yeah.
And finally, I assess the overall industry landscape. Is this an industry that's growing? Right. Are there any significant challenges on the horizon?
Yeah.
Even the best companies can face headwinds if they're in a declining industry.
It's all about understanding the context in which the company operates.
Exactly. It's a straightforward framework, but it gives me structure
Okay.
and helps me avoid getting lost in irrelevant details.
And it's adaptable.
Yeah.
You can apply this framework to any industry, any company size, any investment style. Now, I'm curious, what about valuation? How does that fit into your process?
Well, valuation is essential, of course.
Right.
But I try not to fixate on finding some precise fair value
Yeah.
because it's ultimately more art than science.
There's always an element of subjectivity,
Yeah,
right?
yeah.
Different investors will have different opinions on what a company is truly worth.
Absolutely.
Yeah.
Instead of seeking an exact number,
Okay.
I focus on finding companies trading at a reasonable discount to what I believe their intrinsic value is.
So you're looking for a margin of safety, a buffer to protect yourself if your valuation is off. Like that classic saying, buy low, sell high.
Precisely. If I've purchased the company at a good price, it limits my potential losses, even if my initial valuation was a bit optimistic.
Okay.
And that brings us to another important, often overlooked aspect of investing, understanding your own psychological biases.
Ah, yes. Because we're all human, and we all have biases that can cloud our judgment, especially when it comes to money.
Exactly. And those biases can lead to irrational decisions.
Okay.
Take confirmation bias, for example. It's that tendency to seek out information that confirms our existing beliefs, even if it's not entirely objective.
It's like we're putting on blinders, filtering out anything that challenges our preconceived notions.
Or how about loss aversion? That's the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain.
That can lead to holding on to losing investments for too long, hoping for a miracle turnaround.
Or the opposite.
Oh.
Sometimes loss aversion can cause us to sell winning investments too early.
Right.
Because we're terrified of losing our profits.
Yeah, we get spooked and miss out on potential gains. These biases can be sneaky.
Yeah.
Because they often operate on a subconscious level.
Right.
We might not even realize they're influencing our decisions.
That's the tricky part.
Yeah.
The first step is simply acknowledging that biases exist.
Right.
And that we're all susceptible to them.
Awareness is key. But how do we actually combat these biases?
Well, once we're aware of them, we can start to put systems in place to mitigate their influence.
Right.
One of the most effective strategies is having a written investment plan.
So we're not just winging it.
Right.
We have a roadmap that outlines our goals, our risk tolerance, and our overall investment strategy.
Exactly. A plan helps us stay focused and avoid making impulsive decisions.
Right.
Based on fear or greed.
Yeah.
It helps to keep those emotions in check.
We've discussed the analytical side of investing, understanding businesses, analyzing financials, assessing risk. But you're right, the psychological side is just as important, if not more so.
Investing is all about making decisions under conditions of uncertainty.
Right.
And the better we understand our own minds and how they work, the better decisions we'll make. We'll be less prone to those emotional knee-jerk reactions that can derail our long-term goals.
This has been a fascinating discussion.
Yeah.
We've explored the macro versus micro perspective, the analytical versus psychological aspects of investing. We've even touched on the wisdom of gardening, and we've uncovered some key takeaways. Don't try to be a macro expert. Focus on what's knowable and controllable. Have a framework for analyzing investments. And be aware of your own psychological biases.
Right.
But there's one more essential element we haven't mentioned yet.
Okay. I'm intrigued.
Yeah?
What's the missing piece of the puzzle?
Patience.
Ah, yes. Patience. The virtue that can be so elusive in the fast-paced, always-on world of investing.
Because let's face it, we all want to see our investments grow quickly.
Right.
We crave that feeling of progress, of outperforming the market. But the reality is that building real wealth takes time. It's a gradual process.
It's like planting a tree.
Right.
You wouldn't expect to see a towering oak spread up overnight.
Right.
It takes time.
Yeah.
Care. And the right conditions to flourish.
And just like a tree needs sunlight, water, and nutrients to thrive, our investments need time, compounding, and yes, a bit of luck to reach their full potential.
And that's where patience becomes so crucial. It's easy to get discouraged when the market is volatile, when your portfolio's down, when it feels like everyone else is getting rich faster than you are.
Yeah. We've all been there. It's natural to get caught up in the short-term fluctuations and lose sight of the bigger picture.
But if we can keep our eyes on our long-term goals, tune out the noise,
Yeah.
and trust the process, we're far more likely to achieve the financial outcomes we desire.
It's about having that long-term vision and not letting temporary setbacks derail us from our ultimate destination.
Precisely.
Yeah.
In a world obsessed with instant gratification, patience can be a powerful competitive advantage for investors.
Right.
It allows us to make rational decisions, avoid emotional reactions, and stay the course even when things get tough.
So the next time you feel tempted to check your portfolio every 5 minutes,
Right.
or chase the latest hot stock tip, take a deep breath and remind yourself that investing is a marathon, not a sprint.
Focus on the things you can control. Nurture your investments patiently, and trust that time is your ally.
Now let's shift gears a bit.
Okay.
We've talked a lot about the principles of sound investing, but I'm curious to hear about some real-world examples.
Okay.
In the first part of our deep dive, we touched on Warren Buffett's approach. He famously ignores macroeconomic trends and focuses on identifying high-quality businesses. Can you elaborate on why this approach has been so successful for him?
Warren Buffett is a phenomenal example of how a long-term focused approach can yield incredible results. His philosophy centers around what he calls value investing.
Right.
He seeks out companies that he believes are intrinsically undervalued by the market.
Okay.
And then hold on to them for years, even decades.
Wow.
He's not concerned with short-term market fluctuations.
Right.
He's looking for businesses with strong fundamentals.
Yeah.
Capable leadership.
Right.
And a competitive advantage that will allow them to compound value over time.
It's almost like he's buying a piece of the business, not just a stock ticker. He's betting on the long-term success of the underlying company.
Exactly. And his track record speaks for itself.
Right.
He's consistently outperformed the market over decades, proving that patience and a focus on quality can be a winning formula. But he's not the only one.
Right.
Remember John Maynard Keynes, the economist we discussed earlier?
Yeah, the one who initially struggled with macro predictions, but later found success with value investing.
That's the one.
Yeah.
What's fascinating about Keynes is that he eventually applied his understanding of macroeconomics to inform his value investing approach.
Okay.
He recognized that market psychology and broader economic trends can create opportunities to buy undervalued assets.
So he wasn't completely ignoring the macro picture.
No.
He was using it to identify moments when fear or irrationality in the market might create bargains for savvy investors.
Precisely. He understood that markets are not always perfectly efficient,
Right.
and that sometimes high-quality assets get mispriced.
Right.
This highlights a nuanced point.
Okay.
While we shouldn't try to predict the macroeconomy with pinpoint accuracy,
Right.
having an awareness of broader trends can be helpful in identifying potential investment opportunities.
So it's not about being a macro expert, but about being macro aware, understanding how those big picture forces might be creating distortions in the market.
That's a great way to put it. Now, let's talk about someone who took a very different approach.
Okay.
George Soros. He's famous for his macro bets, like the one against the British pound.
Right.
What can we learn from his approach?
Soros seems to be the exception to the rule, the one who defied conventional wisdom and made a fortune by betting on macroeconomic trends.
He's definitely an outlier. But there's more to his story than meets the eye.
Okay.
While he was incredibly skilled at understanding and anticipating macro trends, a key factor in his success was his access to information. Remember his famous bet against the British pound?
Yeah.
Well, a crucial part of his decision-making process was a direct conversation with the president of the German central bank.
Wow. He had access to insider information that most investors could only dream of. So it wasn't just about being a brilliant macro analyst. It was about having a level of insight that was simply unavailable to the average investor.
Exactly. And that's an important lesson for us. Trying to replicate Soros's approach without that level of access is incredibly risky.
Yeah.
He was playing a different game entirely.
It's like trying to compete in the Olympics. Without years of dedicated training and access to the best coaches and facilities,
Right.
you might have some natural talent, but you're unlikely to win a gold medal.
That's a fantastic analogy.
Yeah.
And it highlights the importance of understanding our own limitations as investors. We need to focus on the strategies that are accessible to us,
Right.
the ones that play to our strengths, and don't rely on having a crystal ball or insider connections.
So we have Warren Buffett demonstrating the power of long-term focused investing. John Maynard Keynes showing us how an understanding of macroeconomics can inform a value investing approach. And George Soros reminding us that exceptional results often require exceptional access to information.
The fascinating spectrum of approaches,
Yeah.
each with valuable lessons for us. But ultimately, the key takeaway is to find an approach that aligns with our own skills, resources, and temperament.
This has been a truly eye-opening conversation.
Yeah.
We've covered so much ground, from macro trends to individual companies, from analytical frameworks to psychological biases.
Right.
But there's one final element I'd love to explore.
Okay.
Earlier, we touched on the concept of thinking small,
Yeah.
focusing on what's knowable and actionable. How does this apply to the average investor who might not be managing billions of dollars like Joel telling us?
That's a great question.
Yeah.
Because even if we're not running a massive hedge fund,
Right.
we can all benefit from adopting a think small mentality.
Okay.
It's about focusing on the things that are within our control and our circle of competence.
Can you explain what you mean by circle of competence?
Yeah, it's a concept popularized by Warren Buffett.
Okay.
It refers to the areas of knowledge and expertise where an investor feels confident and comfortable making decisions. It's about recognizing your strengths and weaknesses
Right.
and sticking to the areas where you have a genuine understanding of the businesses and industries involved.
So it's about staying in your lane and not trying to be an expert on everything.
Exactly.
Right.
Trying to invest in everything can be incredibly risky,
Right.
especially if you don't have a deep understanding of what you're getting into.
Yeah.
It's like trying to play every instrument in an orchestra when you've only mastered the piano.
I see your point. So how can we figure out what our own circle of competence is?
It starts with some honest self-reflection. What are your areas of passion?
Okay.
What industries do you find fascinating?
Yeah.
What businesses do you understand intuitively?
So it could be based on your professional background, your hobbies, or even areas where you've done a lot of personal research and learning. I can see how this ties back to the idea of focusing on what's knowable.
Exactly. Once you've identified some potential areas of interest,
Okay.
you need to dig deeper and really test your knowledge.
Okay.
Let's say you think you're an expert on the tech industry. You shouldn't just invest in every tech company that comes along.
Right.
You need to challenge yourself to understand the nuances of each business,
Yeah.
their competitive landscape,
Yeah.
their long-term prospects, and so on.
So it's about being intellectually honest with yourself and knowing when you're stepping outside of your comfort zone.
Precisely. And this brings us back to our discussion about macroeconomics. For most of us,
Yeah.
macroeconomics falls outside of our circle of competence.
Right.
It's a complex and constantly evolving field.
And unless you've dedicated years to studying it,
Right.
it's probably not the best foundation for your investment decisions.
Exactly. This doesn't mean we should completely ignore the macro environment.
Right.
It's still important to have some awareness of the broader economic context
Okay.
and how it might be impacting the businesses we're interested in.
But instead of trying to predict the next recession or interest rate hike, we should focus on understanding the businesses themselves
Yeah.
and how they might be affected by those broader trends.
That's a great way to think about it.
Yeah.
It's about incorporating macro awareness into our analysis without letting it become the primary driver of our decisions.
This has been incredibly valuable. We've covered a lot of ground today, but I think we've laid a solid foundation for understanding the role of macroeconomics in our investment decisions. Before we move on, let's briefly recap the key takeaways.
Sounds good. We started by debunking the myth that everyone needs to be a macro expert to succeed in investing.
Right.
We emphasized that focusing on what's knowable and controllable is far more effective. We then explored the importance of having a framework for evaluating investments,
Okay.
whether it's understanding the company's story, analyzing its financials,
Yeah.
assessing the management team, or considering the industry landscape.
We also delved into the often overlooked psychological side of investing, acknowledging that we all have biases.
That can cloud our judgment. We
Right.
talked about how having a written investment plan
Yeah.
can help mitigate those biases and keep us on track.
And we discussed the power of patience in investing, emphasizing that building wealth is a long-term game more akin to gardening
Right.
than a get-rich-quick scheme.
We looked at real-world examples of successful investors like Warren Buffett, John Maynard Keynes, and even George Soros, each demonstrating different facets of successful investing.
And finally, we emphasized the importance of defining our own circle of competence, focusing on the areas where we have genuine knowledge and expertise,
Right.
and not trying to be everything to everyone.
Now, with all of this in mind, are there any final thoughts or words of wisdom you'd like to share with our listeners as they continue on their investment journey?
If I could leave everyone with one overarching piece of advice, it would be this.
Okay.
Embrace a mindset of continuous learning.
The world of investing is constantly changing.
Right.
New industries emerge, technologies evolve,
Yeah.
and market dynamics shift.
It's not enough to simply learn the basics and then coast.
Right.
We need to be constantly evolving and adapting our knowledge and strategies.
Exactly.
Okay.
So read books, attend seminars,
Right.
follow industry experts, engage in thoughtful discussions like the one we're having today. Never stop seeking out new information and perspectives.
That's fantastic advice.
Yeah.
We've covered so much in this deep dive, and I think our listeners have a lot to think about. But before we wrap up completely, I want to leave you with one final thought.
Okay.
Something to ponder as you continue to navigate the complex world of investing.
I always love a good parting thought.
Yeah.
What's on your mind?
Well, it's not so much a thought as a challenge.
Okay.
And it goes back to everything we've been discussing today about noise versus signal. The challenge is this.
Okay.
Think about your own investment approach. Do you find yourself getting swept up in the headlines?
Yeah.
Constantly trying to predict the market's next move, reacting emotionally to every bit of news? Or are you more focused on understanding individual businesses,
Right.
building a portfolio that aligns with your long-term goals, and tuning out the noise?
That's an incredibly powerful challenge because being aware of our own tendencies
Right.
and our own susceptibility to that constant barrage of information is crucial for making sound investment decisions.
Exactly. And remember, there's no single right or wrong answer here. Some people thrive on the excitement
Right.
of trying to anticipate the market's every move, while others prefer a more measured long-term approach.
The key is to find an approach that feels comfortable and sustainable for you. One that aligns with your personality, your goals, and your risk tolerance.
And to always remember that investing is a marathon, not a sprint.
Right.
Consistency, discipline, and a focus on the fundamentals are far more important than trying to be the next market timing guru.
Beautifully said.
Yeah.
So tune out the noise, focus on the signal, and stay patient. As we wrap up our deep dive, it strikes me that one of the biggest challenges for investors is separating the signal from the noise.
It's a constant battle.
Yeah.
I mean, we're bombarded with so much information.
Right.
Headlines,
Yeah.
expert opinions, market predictions. It's hard to know what to pay attention to and what to ignore.
It's easy to get swept up in the daily fluctuations of the market and react emotionally to every piece of news.
I mean, we can end up making impulsive decisions that aren't aligned with our long-term goal.
Yeah. It's like trying to have a conversation in a crowded, noisy room.
Right. You can barely hear the person next to you, let alone have a meaningful exchange.
Exactly. So how do we, as investors, learn to tune out the noise and focus on the signal?
Well, I think the first step is recognizing that a lot of the financial news and commentary out there is designed to grab our attention, not necessarily to inform our decisions.
It's about generating clicks and views, not about providing objective analysis.
So we need to be incredibly selective about the sources we trust, the information we consume,
Hmm?
and the people we listen to.
That's easier said than done in the age of information overload, right?
It is. But there are some practical things we can do. For starters,
Yeah.
we can limit our exposure to financial news and social media.
Because, let's be honest,
Yeah.
much of it is just designed to trigger our fear and greed responses.
It's not about providing a balanced perspective. It's about creating a sense of urgency and excitement.
So, instead of obsessively checking the market,
Right.
maybe we should be spending more time
Okay.
reading books,
Yeah.
learning about different industries,
Mhm.
talking to people who are actually building businesses.
That's where the real signal is.
Yeah.
In the fundamentals,
Hmm.
in the long-term trends,
Hmm.
in the stories of the companies that are creating value.
I love that. So it's not about ignoring the world around us.
Right.
It's about being more intentional about where we get our information from
Right.
and how we process it.
Exactly. And this goes back to the idea of staying within our circle of competence.
By focusing on the areas where we have a genuine understanding, we're less likely to be swayed by the noise
Right.
and more likely to spot those valuable signals.
And that allows us to make more confident decisions that align with our long-term goals.
This has been a fantastic discussion.
It has.
We've explored so many crucial aspects of investing,
Yeah.
from the macro environment to individual company analysis,
All right.
from managing risk to understanding our own psychological biases.
We've learned that trying to predict the market based on macroeconomic trends is incredibly difficult,
Yeah.
even for the experts.
We've seen that focusing on what we can control, like asset allocation, fees, and cash management, is far more effective.
We've discovered the power of having a framework for analyzing companies and understanding their underlying business models.
Yeah.
And we've recognized the importance of being aware of our own psychological biases
Right.
and putting systems in place to mitigate their influence.
And most importantly,
Yeah.
we've learned that investing is a journey, not a destination.
Right.
It's a process of continuous learning, adaptation, and yes, patience.
Because real wealth is built over time, not overnight.
So as we wrap up this deep dive,
Yeah.
I want to leave our listeners with one final thought.
A parting piece of wisdom to guide them on their investment adventures.
Precisely. Remember that you don't need to be a financial genius or have a crystal ball
Right.
to succeed in investing.
What you do need is a willingness to learn, a commitment to discipline, and a healthy dose of patience.
Focus on what you can control. Build a diversified portfolio that aligns with your goals.
Right.
And trust the process.
And never stop learning and growing as an investor.
Beautifully said. On that note, we'll bid you farewell.
Thanks for joining us on the deep dive. We hope you've enjoyed this exploration of macroeconomics and investing.
Until next time, happy investing.